Let's kick off our themes for 2026 with the economy. Our theme here is the economic expansion can continue, but there's very little room for error. And when we look at economic growth, GDP is simply a math problem. It calculates all of the personal spending, the business spending, the government spending, and then adds in there the net export number. And when we look at those factors, there's very little evidence that suggests to us that there's going to be some contraction in economic growth for the year. Let's start with the consumer. The consumer continues to defy expectations. When you look at this chart, you can see that there's a very strong relationship historically between consumer sentiment and personal consumption. And what we've seen is consumer sentiment continued to deteriorate last year, but spending held up. Consumers continue to spend. So what we're going to see in the first half of this year is that consumers are going to be handed a very favorable tax package. We're looking at tax refunds that should be up on average about $1,000. Again, that's dependent on your tax situation, but we're looking at a big increase from that tax benefit for consumers. There's other things in the tax package that can benefit all income levels as well. When you look at the standard deduction, the child tax credit for some of the lower income levels that are being burdened by that high inflation, as well as the slowdown in the labor market, you're going to see things like no tax on tips, no tax on overtime. So this is extra money in Americans' pockets, and we do think this money will be spent. So that's just a supportive factor for economic growth. When you look at the AI CapEx build, that's not going anywhere. It's still expected to be very strong in 2026, and we understand there's many risks to an AI overbuild, but let's remember, GDP is a calculation. So if businesses have already earmarked this and they're spending it, it becomes additive into GDP. And you can see that in this chart where you see that this continued spending in AI will go on for this year and next year. Lastly, from a global perspective, the stimulative policies we're seeing here in the US is something we're seeing in other major economies as well. Whether you look at Japan or Germany or even China, these economies are taking some of the negative impacts from tariffs, this deglobalization, and investing in their own economies and specifically their own consumers. When you have a strong global economy, that benefits all. So we do think that that's supportive of U.S. growth for this year as well. Now, we understand we are optimistic that growth can continue, but we're also not complacent on the risks. There is so much volatility in economic data right now. We're still working through the government shutdown and getting some of the data that we missed during that time. We also understand that the administration continues to throw curveballs from an economic standpoint at the economy. We do know it's a midterm election year, and we think that there is some incentive for the White House to get consumers on a better footing, specifically that consumer confidence. So we think that, again, can be supportive of growth this coming year. But we will continue to monitor this because, as I mentioned, there's a lot of fluid things going on. We still have the Supreme Court ruling on the tariffs. We may have a new Fed chairman here in May. We are very concerned from a reflation standpoint and what that means for economic growth. All of these things are worth monitoring, but when you look at the simple formula of what GDP amounts to, it's hard to say we're going to see any contraction in growth this year.